key component of an investment philosophy is your view of market efficiency. Therefore, to come up with an effective investment philosophy, investors need to understand the key principles of market efficiency and be able to form their own views of how markets work and how efficient they are. So the question of whether markets are efficient and the degree to which they are or are not efficient is really central to portfolio management. So if you were to believe that markets were very highly or close to perfectly efficient, then basically you're suggesting that the market price is the best estimate of a firm's fundamental value. And in that case, the optimal investment strategy should be to diversify highly and seek to minimize your transaction costs. Because if price equals fundamental value, there should be very limited to no ability to identify mispriced assets. However, if markets are not perfectly efficient, market prices might deviate from true value, and the process of valuation may be able to be used in order to come up with some reasonable estimate of value that can be used to identify under or overpriced stocks. Hence, market inefficiencies might provide the basis for screening the universe of stocks to come up with some subsample that is likely to have undervalued stocks, or a subsample of stocks that is maybe likely to outperform the market in the future. Now, 3 of these potential strategies for screening that we're going to look at throughout this course are momentum, value, and growth. And there is a large body of academic research that suggests that each of these particular methods may have some merit in terms of identifying undervalued stocks using various mechanisms of screening. So let's go back to the principles of market efficiency and actually just recap on what it's all about. So we know that an efficient market is one where all information is incorporated instantaneously and without bias into prices. Therefore, as we said earlier, the market price should be an unbiased estimate of the true value of some investment. Now, it's important to note that there's a few key aspects that relate to market efficiency. While the market price should be an unbiased estimate of true value, it does not mean that market price should always actually equal true value. It's just that any mispricings need to be random and they need to be unpredictable. So we're not necessarily stressing that we need a perfect world where every asset is perfectly priced, because there's always going to be some noise in stock prices. As long as that noise is unpredictable, then you can't profit from the mispricing, hence markets are still efficient. Market efficiency also does not require all assets to have the same expected return. So this is another important point. Students often think, well, if stock A is earning a higher expected return than stock B, does that mean the market isn't efficient? No. As we've previously learned, expected return should be a function of the risk of an investment, and most particularly the systematic risk. Hence, all assets, in order to generate the same utility, are going to require different rates of expected return as compensation for different levels of risk. So basically what we should see is there should be a relationship between risk and return. Now this is important because if you're screening the universe of stocks to come up with some subsample that you think is undervalued or you think might underperform, it's important that you identify that you have not just systematically screened based on risk and selected a subsample that's just riskier than the rest of the market, hence generates a higher expected return. Also important to note that if one investor, let's say for example, often people point to Warren Buffett in this particular case, if one investor can outperform the market for an extended period, it doesn't necessarily mean that markets have to be inefficient. Okay? The reason for that is because I can get 1,000 people, and I can get 1,000 people to all play a coin toss game 50 times over. Now chances are that 1,000 people playing a coin toss game with an unbiased coin 50 times over, there's going to be at least one person in that 1,000 who, just due to pure luck, is able to pick the way that the coin's going to land a lot more than 50% of the time. Okay? Equally, there's going to be people in that group who pick the way that the coin lands a lot less than 50% of the time. So just because out of that 1,000 people there's one person who correctly picks which way the coin's going to land more than 50% of the time, doesn't mean the coin is biased. The same can apply to financial markets. It's also possible that while some markets are efficient, others are not, and that a market might be efficient with respect to some investors, but not efficient with respect to others as well. So market efficiency really comes down to 3 key propositions. Proposition number 1, the probability of finding inefficiencies in the market decreases as the ease of trading increases. So basically, you're going to be more likely to find mispriced assets where there's less trading. And this is intuitive because the process which should maintain market efficiency and the process by which market prices should be returned to their fundamental value is that of arbitrage. Now, arbitrage opportunities are going to be very easy to exploit where there's quite a lot of trading. There's going to be a lot of people there trying to identify and exploit those opportunities, so price should quickly be returned to its fundamental value. If you've got an asset that's very difficult to trade or not trade often, then you might find that there's fewer people watching that market, or there might be constraints on the arbitrage process. Hence, it's more likely that you could find sustained mispricing in less liquid markets. Proposition number 2, the probability of finding an inefficiency in a market increases as both transaction costs and information costs of exploiting the inefficiency increases. Okay, so not only does the level of trading in a market affect efficiency, but also the cost of trading. Okay, that is because you might find a market like the property market. So in the property market, for example, many people would argue that you can actually identify some houses that might be under or overpriced, or say some particular suburbs that might be under or overpriced. But the issue is that transaction costs associated with trading property are so exorbitant that the actual costs of trying to take advantage of that mispricing are more than likely going to be greater than potential profits that can be achieved from exploiting the mispricing. So in that particular case, we have a market where mispricing exists, but it really can't be exploited. So that's a rationale for why those inefficiency exists there. Proposition number 3, the speed with which an inefficiency is resolved will be directly related to how easily the scheme to exploit the inefficiency can be replicated by other investors. So if you've got some mispricing that can be really easily exploited, chances are lots of people are going to replicate that strategy. Everyone's going to be in there trying to profit for themselves, and the opportunity will disappear quite quickly. And before we move on, it's also important to note here the fact that a permanently inefficient market is actually not a good market for investors. Because the idea of identifying mispricing in a market that is less than perfectly efficient is the notion that you can identify stocks that are either under or overpriced. You can buy the underpriced stocks or sell the overpriced stocks. But the mere process of buying an underpriced stock does not generate your profit. You generate your profit when that price returns to its fundamental value, and hence you can sell your underpriced stock for a gain. So basically what you need in terms of market efficiency is you need temporary inefficiencies whereby the prices return to equilibrium over the long run. If prices remain permanently out of balance, then you'll actually never be able to profit from that mispricing. So, given this argument of market efficiency, given different perceptions around market efficiency, and as I've said earlier, investors need to frame their own views on how efficient they think markets are, one of the key arguments as to why markets might be less than perfectly efficient is behavioural finance. So a key notion underlying the efficient market hypothesis is the view that investors are mostly rational, and even so, when they're not totally rational, that the irrationality we see cancels out in aggregate such that there are no systematic biases. So the market as a whole, on average, does not systematically act in some bias mechanism. However, there's a large body of psychology research that points to the fact that human beings actually may have some pervasive systematic behavioural biases that affect the way we act, and this may filter into investor behaviour within stock markets. So basically the idea of investment philosophies is most of them try to exploit one aspect of human psychology, so investor irrationality or behavioural biases, and try to exploit mispricing that might come about due to that particular bias. Therefore, as part of an investment philosophy, it might be important to understand what some of those behavioural biases might be. So some of the common behavioural biases that have been cited in the academic literature include, first of all, anchoring. So anchoring is the idea where we tend to be slow to update our belief systems, and we tend to hold on to past information or past beliefs, even when it's irrelevant when we're making decisions in the future. Another one is the disposition effect. So disposition effect is that we tend to sell our winners too quickly because we want to lock in our profits, but we also tend to hold on to our loser stocks because we don't want to record a loss because of loss aversion. And what this means is, so we're basically selling off the good stocks, those that have done well, holding on to the duds, and this can have a negative effect on your portfolio performance. And this is argued to be one reason why we might see the momentum phenomena, which is something we're going to look at in a few weeks. Another common behavioural bias is that humans tend to believe that they've got more ability than they actually do. So particularly investors here tend to be overconfident. Now, unfortunately for the men in the group, research also tends to show that men are more overconfident than women. So this is a behavioural bias that particularly affects the male gender, but all humans in aggregate do tend to be overconfident. We also see evidence of herd behaviour. Humans tend to follow the crowd, so this might affect the way that people participate in trading markets and might be unwilling or unable to admit mistakes, hence mightn't learn or change behaviours from those mistakes. So let's just do a really quick experiment, or let's look at an example of a quick experiment that can show how common some of these behavioural biases are. And what I'm looking at here is an anchoring experiment that was done in academic research. So I want you, as we go through it, to think about this for yourself. Write down the answers as we go through and see if you actually are susceptible to this bias. So the first thing I want you to do is to write down the last 4 digits of your telephone number. Now, once you've written those 4 digits down, I want you to have a guess or have a think whether you think the number of doctors that are licensed to practice in London are either higher or lower than this number. Okay, write down your answer, either higher or lower. And now what I want you to do is to make your best guess as to what you think the number of doctors in London might be. So write down how many doctors you think are currently licensed to practice in London. Now, once you've got your particular answer, what we'll look at is what the academic evidence tells us about this particular example. So the idea of this experiment is that you were given irrelevant information up front. You're writing down the last 4 digits of your telephone number. But if there is evidence of an anchoring bias, what we find is that when people are making their best guess as to the number of physicians in London, they actually anchor themselves, or they use some of that past irrelevant information in terms of their decision-making process. So basically related to that, these series of questions were asked to a whole lot of participants in an experiment. And basically those people whose last 4 digits of their phone number were greater than 7,000, their average answer for number of doctors in London was about the 8,000 mark. Whereas those people whose last 4 digits of their phone number were less than 3,000, they gave an answer for the average number of doctors in London to be 4,000. So basically what this is evidence of is that the number you've written down, the last 4 numbers of your telephone number, is influencing your judgment on how many doctors there are in London, even though those 2 bits of information are entirely independent and irrelevant for each other. So there is evidence across a range of different areas to suggest that human beings have these behavioural biases, and as part of your investment philosophy, if you do believe that markets are less than perfectly efficient, it's important that you can identify which particular biases you think have the most systematic effect and identify a trading strategy that can align with that belief.